2 weeks ago, most investors were worried about whether the Fed was going to cut rates. Today, they're watching oil cross $100 a barrel for the first time since the early days of the Ukraine war. And right now, there are two types of investors in this market. The first type is watching their portfolio go red, refreshing their brokerage app every 10 minutes, feeling sick to their stomach. The second type, they're quietly, very quietly making a list. Now here's what I'm going to show you today that almost nobody else is talking about. The energy sector was already up 27% this year before a single missile was fired. The war didn't create this opportunity. The war just accelerated it. And the $1 trillion shift I'm going to walk you through, it was already in motion. The Iran conflict just hit the gas pedal. Stay with me, because in the next 15 minutes, I'm going to show you exactly what smart money saw before the headlines caught up, what they're doing right now, and the specific window that opens and then closes in situations exactly like this one. Let's get into it. Let's be honest about what's actually happened in these markets since February 28th, because the numbers tell a completely different story than what the headlines are shouting. The VIX, which is just the market's official fear gauge, kind of like a thermometer for panic, it's up 106% in 2026. And since the first airstrikes landed, it spiked another 50% in just 2 weeks. The Dow is down 4%. The Nasdaq has lost nearly 5% year to date. The S&P 500 is off about 2.7%. And here's something people are completely glossing over right now. South Korea's stock market just had its single worst day in recorded history, and then its best day since 2008 in the same week. Think about that for a second. That's not investing. That's a casino. But here's the other side of that scoreboard. The side the fear-driven headlines aren't showing you. The energy sector is sitting on a 27% year-to-date gain. Brent crude, which started January below $60 a barrel, touched to $110 this past week. Natural gas prices in Europe doubled. U.S. gas prices at the pump went above $4 a gallon nationally. In California, past $5. One analyst at Energy Flux put out a note that stopped me cold. He said if Qatar's gas infrastructure stays offline through summer, energy companies could generate $20 billion more in profit per week compared to before the war. $20 billion per week. So let me ask you something, and I want you to answer this honestly. While all of this was unfolding, were you looking at the fear or were you looking at the math? Here's the part where I need you to stop and really think. Because the biggest mistake investors make during a geopolitical crisis isn't selling. It's assuming the opportunity started when the war started. Let me show you what I mean. By the time the first U.S.-Israeli airstrike hit Tehran on February 28th, energy stocks were already the number one performing sector in the entire S&P 500, beating all 10 other sectors. Not because of Iran, because of something structural that was building underneath the surface for years. After the last big oil cycle, energy companies got burned badly. They overdrilled, overspent, and destroyed shareholder value. So the entire industry quietly made a collective decision: returns first, growth second. Capital spending dropped. New exploration got shelved. The industry basically stopped building for tomorrow. The result of that? The cost to produce a barrel of oil from U.S. shale today sits around $70. And by 2035, analysts are projecting that number climbs toward $95 as the best drilling spots get used up and producers move into lower quality rock. Add steel tariffs. Add inflation. Suddenly the math on energy gets very, very interesting, even without a war. Then you add a war. The Strait of Hormuz goes quiet. Around 200 ships are currently floating in the region, unable to move. That strait moves roughly 1/5 of the world's entire oil supply every single day. Saudi Arabia's largest refinery, drone targeted. Qatar's export facilities, hit. One of the smartest portfolio managers I've followed, Lucas White at GMO, said it clearly this week. He said the market expected a global glut of oil. The thought was that oversupply would gradually wear off through next year. With actual war and chaos in the Strait of Hormuz, it's taken on a life of its own. So here's the question I want you to hold for the next few minutes, and I'll come back to answer it directly. If the oil shock was already building before the war even started, and the war just made it significantly worse, what does the recovery look like on the other side? Hold that question. We're coming back to it. Retail investors and smart money are looking at the same headlines right now, reading the same news, watching the same oil prices, seeing the same red numbers on the same screens. but they're drawing completely opposite conclusions. And that gap, right there, is where wealth transfers from one group to the other. Here's how the average retail investor is processing this right now. They're seeing $100 oil and thinking, this is bad. Everything will get more expensive. Inflation comes back. The Fed won't cut rates. Stocks will fall. So, they sell their index funds. They move to cash. A few are panic buying gold without really understanding why it's moving. And a handful are making leveraged bets on oil prices they don't fully understand, using money they can't afford to lose. Now here's how smart money, the hedge funds, the big institutional desks, the people managing pension funds, here's how they're processing the exact same situation. They're looking at that same $100 oil price and asking completely different questions. Which producers are genuinely profitable right now? Which companies weren't viable at $60 but are printing cash at $90? Which businesses have so much operating leverage that every single dollar increase in oil adds directly to their earnings? Let me give you one concrete example so this isn't abstract. Devon Energy. It's currently in the middle of an all-stock merger with Coterra that creates a combined company worth around $58 billion. And here's the number that matters. Their cost to produce 1 barrel of oil sits in the low to mid $40. With Brent crude above $80 and now pushing toward $100, the profit Devon makes on every single barrel they pull out of the ground is nearly equal to what it costs them to produce it. That's called operating leverage. And it's precisely why institutional money was already quietly building positions in companies like this before February 28th. ConocoPhillips, the world's largest independent energy producer. Same story. No refining complications. Pure upstream production. When oil goes up, their earnings go up in near direct proportion. Now here's what retail almost always gets wrong in moments exactly like this one. They wait. They want confirmation. They want to see the headlines calm down, the VIX drop back, the smoke clear, and then they buy. But by the time that happens, the smart money that was already positioned has started trimming their positions, and the retail investor just bought their exit. The window doesn't wait for comfort. Now I want to show you something that almost nobody in financial media is talking about. And I mean almost nobody. The clean energy angle. Crude oil crossing $100 a barrel just did something that years of climate policy and international summits couldn't quite accomplish. It made renewable energy look cheap by comparison. Think about that for a second. If you're a corporate finance chief and your energy bill just doubled because of geopolitical instability half a world away, and there's a solar installation or a wind facility that can lock in your electricity cost for 20 years at a fixed rate, that conversation suddenly sounds very different than it did in January. Lucas White at GMO put it clearly. He said elevated oil prices throw open a massive window to accelerate energy independence and push renewables into sectors that were still sitting on the fence. Here's what's fascinating though. Clean energy stocks are barely moving right now. Crude is up over $30 in 2 months. And yet renewables, the logical long-term beneficiary of expensive fossil fuels, are basically flat. The market hasn't connected that dot yet. GE Vernova entered 2026 with a $150 billion backlog in power and electrification before the war started. That number is only going to grow as the energy security argument gets louder in Washington, in Brussels, in Tokyo. Brookfield Renewable Partners reported strong 2025 results with $4.6 billion in available liquidity, meaning they can move fast on acquisitions when the right moment arrives. They delivered roughly 8,000 megawatts of new capacity last year. That's a business in full operational momentum, sitting right at the intersection of two of the biggest tailwinds of 2026. Now let me close the loop I opened earlier. If the oil shock was building before the war, and the war just amplified it, then the recovery on the other side doesn't simply look like oil drifting back to $60 a barrel and everything going back to normal. It looks like a permanent repricing of energy security as a strategic asset, in fossil fuels, in renewables, in the infrastructure that connects them. That's the trillion-dollar shift. And most investors won't understand what happened until it's already finished. Let me talk about how the smart investor actually thinks through a moment like this. Not what to buy, but how to think. Because the thinking is what separates people who build real wealth from people who just got lucky once and don't know why. There are two completely separate trades inside this crisis, and most people are confusing them for each other. The first one is short term. Oil spikes because supply gets physically disrupted. Tankers are stuck. Insurance rates for vessels in the Gulf have gone through the roof. That premium on oil prices is real, but it's also temporary. When the strait reopens, or when alternative routes get established, that extra $20 or $30 of geopolitical fear premium fades. The second one is structural. The global energy investment cycle has been suppressed for years. The cost of production is rising. Demand from AI data centers, electric vehicle charging infrastructure, and emerging markets is genuinely growing. This story doesn't pause when the strait reopens. This story plays out over multiple years. Smart investors are not treating those as the same trade. They're sizing and timing them completely differently. Now here's something worth sitting with, the Russia-Ukraine parallel. When Russia invaded Ukraine in February 2022, energy prices went parabolic. Brent briefly hit $130 a barrel. Natural gas in Europe went completely vertical. And then, gradually, prices moderated. New supply routes got established. LNG terminals got built faster than anyone predicted. Companies that had rushed in at the very peak of the panic got burned. But the companies that had already built out their production capacity, kept their cost structures lean, and held on through the volatility, they generated enormous cash returns over the 18 months that followed. The lesson isn't buy at the top of the panic. The lesson is know your timeline and own the right kind of company for that timeline. Here's the one question I want you to bring to every crisis, because it's the question retail almost never asks. Who benefits from prices staying elevated, and do they actually have the financial strength to survive long enough to collect that benefit? Because a company that benefits from $100 oil but carries $15 billion in debt and needs to refinance in a volatile interest rate environment, that's a very different bet than a company with a $40 break-even, strong free cash flow, and an active buyback program. The reward looks identical on the surface. The risk is completely different underneath. That question, who benefits and can they survive to collect, that's the lens that separates the investors making real money in this environment from the ones trading on hope. Let me tell you why I actually wanted to make this video. Not because I think you should rush out and load up on oil stocks this week, but because moments like this one, when oil is crossing $100 and the VIX is screaming and people are genuinely scared, these are the moments that reveal everything about who you are as an investor. I've watched smart, educated people lose serious money in calm markets because they got complacent. And I've watched ordinary people who didn't go to business school, who learned by build real, lasting wealth in chaotic markets because they didn't flinch, because they kept asking the right questions when everyone else stopped asking questions altogether. The trillion-dollar opportunity I've been talking about isn't hiding inside one stock or one sector. It lives in the discipline to see clearly when the world around you is seeing blurry. Right now, the world is blurry. Oil above $100. Inflation fears reigniting. South Korean markets having the worst day in their entire history, and then the best day in 20 years, in the same week. Inside all of that noise, there are good businesses being mispriced. There are solid assets getting thrown out alongside the fear. There are structural trends that don't pause for geopolitics, the underinvestment in production, the energy transition, the electricity demand surge from artificial intelligence. The opportunity isn't in predicting what happens in Iran next week. It's in understanding what was already true before the war started and recognizing that the war just made it louder. The investors who look back on March 2026 as a turning point, they weren't the ones who predicted the conflict. They were the ones already reading the structure of the market clearly. And they stayed steady when the world went loud. That's what this channel is here for. If this video helped you see the situation differently, not just react to it, hit subscribe, share it with someone who needs to hear it right now, and drop your biggest question in the comments below. What part of this are you still working through? I'll see you in the next one.